What's up everybody, Gen X Dividend Investor here. In this video I help you uncover why your dividend snowball might not be growing as quickly as you'd like, and will show you how to accelerate your path to financial freedom. And to level set, a dividend snowball is the term used to depict your dividend income growing over time, faster and faster, due to dividend increases and due to getting more shares, often by reinvesting the dividends you receive as well as from additional buys you might do. It's an amazing compounding strategy because as you own more shares, you earn more dividends, which lets you acquire even more shares, creating a virtuous cycle of compounding growth. Your income snowball starts small when you're at the top of the mountain of your investing life, and then as time goes on and you roll down that hill, your share count and dividend hikes keep growing your income faster and faster. Your money, in the form of stocks, is now working for you rather than you working for it, because now it can grow and produce cash flow on its own. And if you're holding your shares in a Roth, then you basically don't have to worry about paying taxes, and if your dividend reinvestment plan is on, then each payout means your total number of shares is going up. Of course, you need to make sure that you own quality stocks that are growing, because who wants to own more shares of something that is declining? Let's take a look at an example of a dividend snowball in action so it really makes sense to you, and then I'll explain reasons why your dividend snowball isn't growing faster. Okay, this is a screenshot of the input parameters for a tool I created in my dividend spreadsheet product that shows how a snowball and portfolio can grow over time. In this case, I put in a starting value of $10,000 with a portfolio average weighted starting dividend yield of 3%. That just means that the combined dividend yield of the portfolio is based on the proportion of each investment's yield and value relative to the total portfolio. I then put in a dividend compound annual growth rate of 5% and left inflation at 0%, but you can always put in 3% or whatever if you want to see how your future estimated income's buying power compares to today. I also put annual share price increase at 5%. Finally, I assumed that you weren't investing any other cash into your portfolio and thus left the input field for monthly cash added at $0. The spreadsheet then shows you how your portfolio and dividend income could grow quarter over quarter for 60 years, both if you are reinvesting your dividends and if you aren't. In my personal portfolios, I reinvested dividends for over 25 years until my post-tax divvies grew larger than my family's expenses, at which point I started spending almost all of my dividends, and I reinvested the remaining small portion I didn't use. Okay, let's quickly go over the columns you see here. Each row represents another quarter in time, and we start with today's date. Then we have share price, which slowly trends up per our inputs. Then the number of shares in the portfolio if your drip is off, which stays at 100 shares in this no drip column, given we started with a 10K investment. Then there's a column for the number of shares as you drip, so this number slowly increases with each quarterly buy. Then there's portfolio value assuming you aren't dripping, and a portfolio value if you are dripping. Then there's a column for how much dividends per share per year are being paid out. Then we have a column for your quarterly dividends paid if you don't drip, and one if you do drip, and then columns for annual dividends paid out as well. Then we have a column for dividend yield over time given the input parameters we use, then a column for how many shares you purchase if your drip is on, and how many shares you'd buy if you were adding more cash to your portfolio. Obviously, the drip portfolio value and income columns will grow faster than the no drip ones, and you can scroll through the various rows to see how it changes. It's nice to see how the data evolves as time goes on, as it really gives you a sense of how compounding increases with the drip on and everything grows faster and faster. Pretty neat. Okay, I also created this multi-decade summary view of all that quarterly data. So like by year 10, if you weren't dripping, you would still have your original 100 shares, versus if you had been dripping, you would be at 130 shares. Then at year 20, you'd have about 174 shares if you were dripping, then 232 shares by year 30, 308 shares by year 40, and 408 shares by year 50. If we look at portfolio value over time, we see that by year 10, the no drip portfolio is at 15K compared to 20K for the drip portfolio. By year 30, the no drip is worth 42K versus 98K for the drip, so now the reinvested dividends portfolio would be over twice as big. At year 50, the no drip portfolio has grown to 114K, which is still amazing as it's 11 times what we started with, but that's nothing compared to a portfolio that had been reinvesting for 50 years, which would have grown to 466K, or about 47 times as large. And remember, this is without contributing any more investments into your portfolio, and doing that greatly increases your snowball's growth. If we now look at how dividend income grows, we see that by year 50, the no drip income has grown from $300 a year to almost $3,300 versus over $13,000 a year for the drip portfolio. And that is the compounding dividend snowball in action, where your dividends start small and slowly acquire shares, which then gives you even more dividends, and the cycle keeps growing faster and faster and your income snowball keeps expanding, at least as long as you're invested in quality companies that trend up over time. And that ties into a big reason why your dividend snowball might not be growing as fast as you'd hope, and that's if your companies are suspending, cutting, or simply not increasing their dividend. Great companies find ways to continually grow, either with new product offerings or into new geographies or whatever, and then they can hopefully pass off more of their profits to the shareholding owners of the company. And remember, about 80% of the S&P 500 pays dividends, so don't be fooled by people who tell you that they're irrelevant. They may not be relevant to those people, but I assure you that they're relevant to people who understand their power and value prop. I mean, there's a reason why Google, Salesforce, and Meta all initiated a dividend this year, joining tech companies like Apple and Microsoft and Nvidia that already pay them. And do you really think that Zuck or Tim Cook or Mark Benioff or whomever would pay dividends if they were meaningless or irrelevant? Or maybe they're all stupid and the people who say dividends are irrelevant are right. The fact is that some people, especially retirees like myself, specifically seek out good dividend stocks to focus on because we appreciate companies who distribute some of their profits to their owners. And the more of us that do that, the more the prices of those stocks get pushed up, kind of disproving the notion that a firm's dividend policy does not affect its valuation. Though to be fair, stock price doesn't always equal value, at least in the short term. Beyond that, the dividend naysayers would say that rational investors shouldn't care if they get dividends or capital gains, and all that they should care about is total returns, but that also doesn't always hold in real life. I did a video on why dividend investors should care about total returns, though I also explain why investors also care about other things, sometimes more than total returns. I mean, if you only cared about total returns, then why don't you go all in on Bitcoin, which has had the best total returns over the last 15 years? Of course, who knows what the future will bring. And congrats, because Bitcoin just hit 100K as I was working on this part of the video. Or if you only cared about total returns, then I'd guess you'd say owning bonds doesn't make sense because they've underperformed equities over the long run. So maybe there are more things than just total returns that investors in real life focus on. We all have different needs and risk tolerances, and not everyone wants the same thing. Beyond that, another thing that pokes the dividend irrelevance arguments in the eye is that dividend distributions can be taxed differently than capital gains, and the theory assumes no taxes. But hey, sign me up for a world that exists without taxes, then maybe the theory would have less holes. The reality is that dividend stocks are often desired as they tend to be safer stocks that hold up better in market downturns, and that drives specific types of investors like myself. Many of us see dividends as a signal of a firm's financial health, as one of the many things we look to when investing in a company. I also personally value what dividends bring me and my family, especially due to the health conditions I have and due to the fact that my wife is bad with numbers and realistically doesn't have the interest or maybe even the ability to actually sell stocks in a reasonable way. So while some people say that you can simply sell shares of a non-dividend stock to manufacture your own dividend, the reality is that there's a lot more benefits to dividends than just that. I mean, selling stocks decreases your ownership in a company. Selling stocks means you actually have to log in and determine what to sell and how much, etc. Selling stocks means you got to deal with times when the market crashes and you got to sell even more shares to make the same amount of income. Selling stocks means you could run out of cash if the market trends sideways for longer than it historically has, because the 4% rule was modeled looking at historical markets and trends. I can go on, but there are lots of benefits that come from good dividend stocks that go far beyond thinking you could just sell shares to get the same effect. So go ahead and say that dividend investing is irrational, but hey, the market is irrational, so feel free to ignore the realities that exist. To me, dividend investing is the best way to get income, especially for people who want it passively. Moving on, another limiter to your snowball growing fast can be if you have low dividend yield stocks and or low dividend CAGR stocks. Generally speaking, you'll find a correlation where lower yielding stocks have higher dividend growth rates. I could do an entire video on explaining why that is, and leave me a comment if you'd like me to do that. One key reason that lower yielding stocks tend to have higher dividend growth rates is because they often prioritize reinvestment over immediate payouts, enabling them to grow earnings and potentially dividends more rapidly. In contrast, high yielding stocks prioritize steady income, often limiting their capacity for future dividend increases. This trade-off reflects the broader balance between growth and income strategies in investing. Of course, if you have low yield or low CAGR stocks, it doesn't mean that you should knee-jerk sell those tickers and instead go for higher yield or higher dividend CAGR stocks. I mean, I hold Apple and Microsoft in my portfolio to give me some more stock appreciation potential, and because I like the tech play aspects. I recognize that those sorts of tickers don't help my dividend income much in the short and medium terms, but they help me in other ways. Now, I'd be fine to sell them for a variety of reasons, so just make sure to think carefully when it comes to your snowball and portfolio and such. If your entire portfolio is filled with low-yield stocks and you want to increase your passive income, then obviously you could consider balancing your portfolio with good higher-yield dividend stocks and dividend growth stocks that are known to increase their payouts. Maybe evaluate dividend aristocrats and kings to find some stocks that fit your needs. However, another reason that your dividend snowball isn't growing faster might be due to you doing the exact opposite and chasing super risky high-yield tickers that can't sustain their dividends or distributions. Sometimes that can work out for a while, but it's also not uncommon for high-yield stuff to go bust. Going too risky is something many new investors do, and that can obviously kill your snowball. For example, I just saw this Wall Street Journal Instagram post about a 60-year-old named Richard who's an industrial mechanic that got laid off from his longtime job. Soon after that happened, he was unfortunately diagnosed with colon cancer. A friend of his told him about a wealth management firm that guaranteed a 15.25% return to its investors on some of their products. Richard figured that investing with them must be an amazing opportunity and that he'd be set for life. So he withdrew his entire 401k from Fidelity, which was valued at $763,000, and transferred it to the company he heard about. But a short while later, they sent a notice that the firm was liquidating their investments and winding up their affairs. Now poor Richard and their other clients don't know if they can cash out, and if so, how much they could expect to receive. His experience is an example of an investor chasing super risky, potentially high return stuff and then losing big. It's pretty common for me to hear from people who think they'll average 15+% returns over multiple years, and yet that rarely plays out as they'd expect, even though they're often supremely confident in their investment. So my advice to you is to be very wary of people or products that claim they can sustain 15% plus returns, or really anything that comes close to the market. Yes, every so often something comes along for a period of time where it can do big returns like that and even more, but very, very few pan out over the long run, and more often than not you end up holding crap. Moving on, another big reason why your dividend snowball isn't growing faster may be due to the person in the mirror. Specifically, I'm talking about if you can't control your emotions, then that can lead to you making decisions which melt your snowball. For example, if you can't control your fear during market downturns, then you may sell after the market has crashed in hopes of avoiding further declines, ultimately locking in your losses rather than holding and waiting for the recovery. Oftentimes, people who sell in fear also miss out on market rebounds and long-term growth opportunities. Like a few years ago, I saw how one of my close friends sold out of all his stocks after the markets tanked when the pandemic hit because he thought the impact would be so harsh and extend for so long that he just couldn't stop himself from selling. But then he completely missed out when the markets came storming back, and he eventually limped in again after losing out on 50% of his returns. So trust me, it is really hard to sell near the top and buy near the bottom, even though people talk about doing it all the time. Other emotions that can negatively impact your dividend snowball are greed and overconfidence. Greed can lead to chasing high-risk speculative investments, often at market peaks. So you overpay for a stock that has shot up, probably right before its bubble bursts, all leading to significant losses, and then when it crashes down to earth, your glass hands sell, right as it turns around to go back up. Or maybe you have overconfidence in some stock you bought, and you end up paying a huge premium to get into it, and all that can act like an anchor to a growing snowball relative to investing in something better. Impatience is another snowball killer. Emotional impatience might push you to exit investments prematurely. Like if you're expecting quick returns and then they don't show up, you freak out and sell. The fact of the matter is that good dividend investing is a long-term game. It's a marathon, not a sprint, and you need to have patience for your snowball to keep growing. Another emotion that can melt your snowball is if you're someone who is prone to confirmation bias. Like maybe you only look to, or listen to, information that confirms your pre-existing beliefs, and that might lead you to sticking with poor-performing stocks or ignoring warning signs, which can mean reduced portfolio performance and or missed opportunities to reallocate assets, all of which diminishes your dividend snowball growth. Regret avoidance is another emotion that can stunt your snowball. Basically, the fear of making a wrong decision might prevent you from taking action, like not investing during market dips. Your inaction in the market leads to missed opportunities, which can lead to a diminished snowball. And speaking of the market, another emotion which can hurt your passive income growth is if you fear walking on your own investing path. Like if you chase the herd that are panic selling or panic buying, because hey, everyone seems to be doing that, then that often leads to underperformance compared to a disciplined, independent strategy that you've developed. You also want to be careful if your emotions are anchoring you to your tickers. There are times that it makes sense to sell a stock, and I did a video on that topic you might want to watch, though generally I prefer to buy and hold. That being said, some people hold on too long to their losers, and doing that can limit your snowball's ability to grow. And holding onto your stocks reminds me of another emotion that can hurt you, which is loss aversion. Basically, when the fear of losses outweighs the joy of gains, that can lead to overly conservative investing or reluctance to take calculated risks, leading to a lower portfolio growth and ultimately a snowball which isn't growing fast. So how do you overcome all those emotional investing concerns? Well, number 1, create a plan. Have a clear investment strategy that includes asset allocation, risk tolerance, and goals. Number 2, consider automating your investing. Use automatic contributions and dividend reinvestment plans to reduce any emotional decision making. Number 3, focus on fundamentals. Make investment decisions based on company fundamentals, not short-term market movements. Okay, and another big snowball killer, and it might be the worst mistake of all, is if you don't hit that thumbs up button, nor subscribe because you haven't yet, and if you've not clicked that bell notification. Another snowball killing mistake comes from poor stock selection. I mean, if you want sustainable dividends, then you need sustainable earnings. Your companies need to be in good financial health and have positive prospects for future growth, as weak companies mean weak snowballs. And along that vein, you want to probably guard against overly defensive allocations of stocks. For example, a portfolio too focused on low volatility, low growth dividend stocks, like utilities, might yield steady income but will limit your growth, both in terms of stock appreciation and dividend income appreciation. So include some good dividend growth stocks in sectors with higher potential, like tech and consumer discretionary. And the fourth way to help overcome emotional investing concerns is to continually educate yourself more about investing. Understanding market cycles helps you stay calm during volatility. Keep learning from videos, read books, talk to dividend investors on my free dividend Discord and stuff like that. And then don't blindly accept what you hear without verifying things on your own as well. Ultimately, by managing your emotions, you can stick to a disciplined, rational strategy that maximizes the growth potential of your portfolio and snowball. Moving on, another reason why your dividend snowball isn't growing faster is if you aren't pouring more cash into your portfolio. Treat your investing like a tax you gotta do, and eventually you'll enjoy paying that tax. And realize that using dividends for living expenses instead of reinvesting them slows the compounding process, so try to reinvest as much as possible to accelerate your snowball's growth. Each share you acquire pushes your snowball to grow faster, and time itself becomes your best ally. Compounding strategies need time to develop, and a dividend snowball requires lots of time to fully unleash its growth power. And even if you have time, you also gotta have consistency with your investing. Keep pushing that snowball downhill to help it grow even faster. And that reminds me of a great word to reflect on, which is focus, and how important focus is to achieving long-term snowball growth. Turn it into an acronym and you get follow one course until success, which emphasizes the power of commitment and persistence in achieving your goals. Staying focused means prioritizing a single objective and dedicating your time and energy to it without being distracted by competing interests or activities or assets. Having focus is important because concentration amplifies results. What I mean is that by directing all your efforts toward one path, you gain momentum and achieve goals of snowball growth even faster. Focusing on a key goal reduces the number of choices you need to make, helping you stay consistent. Maintaining focus hones your ability to resist distractions and stay on course. And whether it's financial independence, health, relationships, or personal growth, focusing on one goal at a time can make the path to success clearer and more achievable. Another aspect of focus is sticking with stocks. Some people invest in tons of different asset types, from currencies to bonds to real estate to CDs to whatever. And that can work, and it's probably better than not investing, but in my experience, the people who got wealthiest the fastest tended to focus on one asset until it grew large. I mean, if you stick with investing in good stocks for a long period of time, then I'm confident you'll win, and at that point you can diversify into other things. So yeah, it can be okay to invest in multiple asset types, but just realize you're diluting your focus to grow that snowball faster. Another snowball killer is if you quit investing when markets crash and your portfolio falters. Huge snowballs are built by people who take the punches, who don't quit when cuts happen, and who don't give up when black swan events kill the market. Okay, another reason why your dividend snowball isn't growing faster might simply be due to the fact that you just started investing and your portfolio is still tiny. A small portfolio means small dividend income, and it will take a long time for compounding to do its magic. Another reason why your snowball isn't growing faster could be due to losses you're incurring from fees or taxes. Like maybe your mutual fund is charging a ton, relative to its return potential, to manage your ticker. A solution might be to consider using low-cost index ETFs, and of course choosing brokers with minimal to no fees. Or maybe you're holding tickers in certain brokerage accounts that aren't ideal for them to be in, causing your snowball's growth to be stunted due to the taxes you owe. The simple solution is probably to use tax-advantaged accounts like Roths to minimize drag that can impact your dividend reinvestments. And yet another reason why your dividend snowball isn't growing faster may be due to market volatility. What I mean is that during bear markets or economic downturns, companies may reduce or suspend dividend payments. That's why it often makes sense to diversify across sectors and industries and geographies to help reduce the impact of sector-specific downturns. So what do you think? Are you pushing to make your passive income grow faster? Or maybe do you feel like growing your dividend snowball doesn't really matter? I mean, according to the Stoic philosopher Epictetus, true wealth is not defined by material possessions, but by having few wants and inner contentment. He said, wealth consists not in having great possessions, but in having few wants. So being content in what you have means being wealthy. You need to appreciate your life and what you do have, even if it's not the ideal you hope for. The more you long for something else, the less you're appreciating what you already have. Then again, maybe your dividend snowball will give you what is most precious in life, which is the freedom of more time. Your snowball makes it easier to focus on doing more of what you want to do, as well as doing less of what you don't want to do, at least when it comes to finances and financial freedom. Now I'll close things off by shouting out Todd A., who just upgraded from a Patreon champion to an aristocrat. Thanks, I really appreciate your support. I'd also like to make a pitch that everyone check out my FastGraphs affiliate link along with my coupon code in the description of this video, as using both should allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also say that you should try out my Seeking Alpha affiliate link, as new users often get good discounts for signing up, and they have a special Black Friday sale running from now until December 11th, 2024. They said that they don't plan to run another sale for a long time, so if you've ever thought about signing up, then I'd recommend doing so now, maybe as an early Christmas present. Plus, take a look at my Patreon seats to see if there's any you want to sign up for, but if those are sold out, like they often are, then please consider joining as a channel member as these folks have, because memberships gives you a bunch of perks I think you'd enjoy. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.